Well, hello there guys, and welcome into lesson 31. In this one, we're talking about share buybacks and why share buybacks help in three big ways. Most people, when they view a share buyback that a company does, which by the way, a share buyback basically means a company is going to purchase their shares off the market and they're going to expire those shares. And we'll get into why they want to do that and whatnot. But most people, when they view this, they think like the only way it really helps is it helps in the EPS. It makes the EPS look better, the earnings per share. It makes them look better as they buy more shares off the market. And really it helps in two other big ways. But EPS is definitely a way it helps, okay? It helps out the earnings per share. So let's say a company has 2 shares outstanding, all right? That's unrealistic. I mean, most companies have hundreds of millions, if not billions of shares outstanding. Let's say this company just has 2 shares outstanding, and currently they've got $1 in earnings, I guess you could say. $1 in earnings. So if they got $1 in earnings, they got 2 shares, then basically they're making 50 cents per share, all right? They're basically making 50 cents per share in EPS right now, all right? Earnings per share is 50 cents right now. Now, let's say they do a share buyback and they buy 1 share. So that brings them down to now they only have 1 share left outstanding, all right? So if they got $1 of earnings still, and they got only 1 share outstanding, now they have $1 in EPS. When that EPS looks better, guess what else looks better? Generally, the PE ratio looks better, right? Because if the shares were trading at, let's say the shares were trading at $10 in the markets right now, right? Well, before, if they had 50 cents of earnings per share and they were trading at $10, that means their PE ratio was a 20, because you basically just take 10 and divide it by the 50 cents, you got a PE of 20. But now if they got $1 of EPS because they bought that other share and expired it, now all of a sudden this PE goes all the way down to a 10 now at this point, because now we're doing 10 divided by 1. So now all of a sudden the value investors say, wow, now we definitely want to buy this one, and investors in general. So that's the obvious way that a share buyback really helps, okay? The second way that not a lot of people really think about is what it says about the belief management has in that company, okay? So that's a big thing, guys, the confidence that it puts out there that we're going to buy our own shares back because we think they are undervalued right now. Management, when they announce a big share buyback, they're essentially saying, we believe the shares are undervalued right now, so we're going to go ahead and we're going to buy some of these shares off the market. It's a big thing. That's a big confidence boost, because management could do anything with that money, right? They could spend it on acquiring another company. They could spend it on dividends, which is paying you out, the shareholders out, money in dividends. They could spend it on, the business itself and reinvesting it or whatnot. They could do all these different things with the money. They could just keep it on the balance sheet. But the fact that they do a share buyback is essentially saying that they believe the shares are really undervalued at that moment, and they're going to announce a share buyback, get it approved by the board of directors, and then go out there and actually start purchasing shares in the open market. It's a big thing. That's a big confidence boost that not really a lot of people think about. The other way is the third way is even a bigger thing, in my opinion, that is totally unnoticed in a share buyback. Well, a company announces, let's say, most of these companies announce multi-billion-dollar share buybacks. They announce multi-billion-dollar share buybacks or hundreds of millions, okay, that they're going to buy back billions or millions and millions of dollars in a share buyback. Well, okay, so that basically puts a huge buyer in the market, okay? So you got a huge buyer. This is like, if you're going to buy billions and billions of dollars worth of shares or hundreds of millions of dollars worth of shares, that's like essentially having a huge institution being able to buy shares like crazy, like a massive hedge fund going in and saying, we want to invest in this company and buying shares. What's that going to do? It's going to put a huge buyer in the market. We know prices of stocks, how do they go up? Basically, they go up if you have more buyers than you have sellers, and the stocks go down when you have more sellers than buyers. When you have a big corporation buying their own shares, that basically going to, generally speaking, it's going to end up making there be way more buyers in the market, because this company is trying to purchase, maybe several $1 million worth of shares per day versus, a company that's not doing that. So you got a huge, massive buyer out there, guys. Apple stock, Apple's, just a company, for example, that's doing a massive share buyback. Apple's one of the biggest buyers of Apple stock is Apple itself. They're a huge buyer in the market, which can help prop up their price and make it look even better and keep price stability and whatnot, which is a big, big thing. And that goes back to even more confidence, okay, in the company, because if a price is more stable, it shows that there's even more confidence out there in the company. If a stock just drops 50%, all of a sudden over a few months span or a year span, all of a sudden people are going to say, maybe not that confident in that company. Look, those shares just went down 50%. But if there's stability there in a constantly rising price, it shows institutions that maybe that stock's less risky, which institutions, remember, they don't want to take huge risks. These institutions, these hedge funds, they don't want to be in a stock that also goes down 40, 50% in a real quick amount of time. Why? Because a lot of their investors will end up pulling out their money. If you have a big position as a hedge fund manager or a mutual fund manager, and your stock all of a sudden goes down 40, 50%, and you were invested in that, you're going to have a lot of investors looking at you like, why am I with you? Why don't I go, with somebody else and have them invest my money? They don't want that situation, because the more people that flood out of there, or the less people they're going to make commissions on. And right, if they got, $1 billion, or let's say $100 billion invested on your capital versus $1 billion, is a massive difference in the amount of money they can make for themselves. So they don't want investors leaving. So big hedge fund managers, big mutual fund managers, when they see price stability because a company's buying their own shares back or a price appreciating, they're going to say, wow, there's less risk in that stock to make me look like a fool and things like that. So those are two really big things. I mean, it's three big things. The EPS, obviously, it helps. That's the obvious thing. The other big thing is having a huge buyer in the market, guys. It's big. You're going to have a big buyer in that market. And the other thing is what it says about confidence that management has and the board of directors has to initiate a share buyback and say, our shares are undervalued, we believe right now, or at the worst, a fair price, and we want to start taking these shares off market. We think this is a better allocation of our capital than giving it to you guys out in dividends. We think it's better allocation of our capital than buying another company to acquire, and we think it's better allocating our capital to this rather than putting it back into the business. It's big, guys. It's a big confidence boost out there. So I hope you guys enjoyed this lesson. Don't forget those three big things. And I love buying companies that are doing share buybacks. It's not like I won't invest in a company that's not doing a big share buyback, but I love investing in them, guys, for those big reasons. It's going to end up making the EPS look better as long as that company can be just as profitable, if not more. It's going to give out a lot of confidence out there, and it's generally going to make the price probably go up over time just because you got a huge, massive buyer in the market, guys. So I hope you enjoyed this lesson, and let's go ahead and get into lesson number 32.